Hello, everyone, and welcome to our first Growth Mindset Series of 2026. I'm Melissa Spring. I'm a global service consultant on our US West Central team, and we are excited. We have four expert speakers lined up for you this year, each bringing some unique insights, tools, and strategies to help you sharpen your skills and strengthen your businesses. So I'm excited to kick off the series by introducing our speaker today, Peter Dunn, also known as Pete the Planner. Pete is a financial expert, author, and media personality dedicated to helping people improve financial wellness and build stronger futures. So, with that, I will turn it over to Peter.
Thank you so much. It is good to be with all of you. I'm joining you today from Indianapolis, Indiana. I see in the chat you're all over the place in North America, so it's good to be with you. What I would love to know, instead of reading every city apparently in North America on here, how many years have you been in the real estate business? How many years have you been in the real estate business? Uh, wow, some real pros here. Uh, Decades and decades is what I'm seeing. I did see a first year person, a couple of months as well. No matter how long you've been in the business, whether it's a couple months or a couple decades, there's something that you know, and that is that getting your finances right is what keeps you in the real estate business. So I have had the great fortune over the last 25 years of working with hundreds of thousands of realtors all over North America with their finances. I even wrote a book about managing a commission income, which is what you all do every single day. And for such a long time as a financial advisor, I did the same thing. But today we're going to talk about how to make sure that when you feel abundant because your production is through the roof, that your financial life actually matches it as well. As you heard in the introduction, I tend to talk a lot, whether it is videoed and broadcast across America or, of course, in audio formats as well. But today we're here to focus on you. All right. So, has this ever occurred to you that you might technically be the greatest seller of homes in the history of mankind, yet that doesn't make you a financial genius? And the tough part about this is there is math, there is money, there is behavior involved with your job every single day. You have to get people to make financial decisions in their life, yet that doesn't mean that you know exactly how to run your financial life. I think it's okay admitting that. I think there's a natural guilt in the fact that you're talking to people about the most expensive thing they will ever purchase over the longest period of time, paying the largest percentage of their income and the largest amount of interest they will ever pay. That is something you advise on a regular basis. And it is okay in front of me and all of your colleagues to just take a deep breath and say, yeah, but that does not mean I am fully financially stable. My goal for this session today is to improve your financial stability. That's all I want. I want you to feel more stable and more confident than last year. So let's do this now that we've gotten all the where you froms and how long you've been in the business. I want you to rank yourself on a scale of 1 to 10. I don't mean aesthetically, okay? I mean, I want to know last year, if 10 was you lived an excellent, stable, smart financial life, and 1 is, boy, am I glad Pete's here. How did you do in 2025, 1 to 10? Paul with the 10, bold. Paul, you are either very confident and bold or very confident and bold. That is good to hear. I see a few 10s coming through. And of course, someone said 6, 7 because they clearly have teens. All right, I see a 9.5. I'll take that. All right, well, let's see if we can make it a little bit better. How can you take control of your taxes, your cash flow, and your long-term finances in 2026? So the goal of it is simple, is that we want fewer surprises. We don't want that scenario where it is tax season. And of course, since we got folks in Canada and in the United States, I'll be talking a little bit about both tax systems here today. But at least as I know in the United States, when it becomes tax season and you get that email from your accountant and there is a number and it is either 5 or 6 figures and it is uncomfortable. And it's not, oh, this is your refund. It is, hey, I hope you set this money aside because this is what we're looking at. I'll also say, and I should have started here, I honestly believe there is no profession in the world that has a more difficult time, understandably, running their finances as real estate professionals. I say that with empathy. I say that with experience. I say that you are in an industry that sometimes is feast and sometimes is famine. You're in an industry in which you get a big chunk of money, and if you set money aside for your tax obligations, you should be okay. But there's a lot of instances in which you find lots of reasons to not set money aside for tax obligations. I'll also say that whether you are in commission sales as someone in the car business or a realtor or a mortgage broker for that matter, not knowing how much money is coming in makes it nearly impossible to budget. People used to say, well, yeah, shooting an arrow at a moving target is a really hard thing to do. Well, that's not the nature of the real estate business. The nature of the real estate business is you don't know how many arrows you have, and you don't know if you get to fire one once a month, every 4 months, every 6 months. And again, we're trying to look at this through the lens of abundance here today. And the odd part about that is abundance, when tipping you too far in commission sales, can find you with scarce resources. So there is absolutely a balance of thinking positively, but not toxically positively when it relates to abundance and scarcity. More control. The fact of the matter is, I need you today to tap into the most disciplined area of your life, no matter what that area is. Maybe it's you never miss an episode of Survivor. Maybe you work out every single day. Maybe you have a quiet moment of prayer or reflection every day. Whatever it is, where you have the most level of discipline and consistency, we're going to talk about tapping that in your financial life. The fact of the matter is, most of us have 1 to 2 areas of our lives in which we are absolutely consistent and disciplined, that we can execute, that we are in a groove. It is self-control. The decisions we make have nothing to do with sacrifice. It is turned into self-control. The issue with money, especially when your job is to create money out of thin air with a 100% commission income, is that it is very, very easy to not have self-control with your finances. So we will spend significant time on that. If I were to send an email to you 12 months from today, which, by the way, I might be the one person not sending you an email 12 months from today. I'm not emailing you. But if I were to, and I were to say, hey, do you have self-control more than you did 12 months ago? And you said yes, then I think the hour we spent together today would be a success. And then finally, how about less Sunday scaries? It might be a little different in the real estate business because you might be doing open houses or driving home from open houses on Sundays. But for a lot of professionals in Canada and the United States, when you get that feeling in the pit of your stomach around 6 p.m. on a Sunday night, when you think, in about 14 hours, I'm going to be back at work. Whatever moment of respite I had in not thinking about work is over. And now I'm anxious. And now I'm not openly talking to my partner for the next few hours before I go to bed. These are the Sunday scaries. This is what I want to prevent for you. I also, as we talk about this, let's talk about this as though you're an employee of your own company. Okay, so let's say you are both the CEO of your own company, and let's say that you are also the mailroom clerk of your own company, which in many respects you are. As the CEO, do you believe that the mailroom clerk makes better decisions in the workplace when they're financially stressed, or do you believe they make worse decisions in the workplace when they're financially stressed? Now, I know that seems like a hypothetical, but the reality is the sales industry for a very long time has been trying to convince people that you, the mailroom clerk, will make better financial decisions when you're stressed. This is why my very first sales manager in the year 2000, Brian, spelled with a Y, in the right place, of course, tried to take me to a car lot my second week on the job as a financial advisor, a month removed from college. And so what happened in that moment is that he tried to commit me to payments so I would have stress and rally and have a better financial life. Now, here's the thing. That was some 25, 26 years ago. I can tell you this. A lot of you have been in this business for a very long time, and you have either knowingly done that to yourself or unknowingly done that to yourself. You have said something publicly to a partner or someone who you share finances with, or a trusted friend or colleague, that puts you on the hook for financial stress in the hopes that you rally, that the fight or flight kicks in. Today is not about that. I do not want to put pressure on you and put your feet to the fire and see if you can handle it. My goal in all of this is self-control. Okay, so before we get there, and believe me, we're going to get there. A lot of preamble here. Income volatility is not going away unless you start to pay yourself a salary, which is a beautiful, beautiful way to run a commission income business. And that is to say that you take a moment, you calculate what your expenses are on a monthly basis, and then you pay yourself that amount, whether you have a good month or a bad month. If you have the greatest month in the history of real estate, you don't pay yourself a dime more. You pay yourself the exact salary that you always get. If you are in the midst of a moderate to better year, or if that is on the horizon for you, that is a very, very realistic thing to do, is to put yourself on a salary. And in fact, that's exactly what I did a few years into my career, and it makes a massive difference. That way, when you have success at the closing table, it impacts your life positively. When you don't get the offers and the closings that you want, it doesn't impact your financial life as badly. It makes a lot of sense. Commissions do not equal profits. You know this. In fact, I would argue to say commissions don't even necessarily equal household income. I think this point specifically is why so many real estate professionals are forced to leave the business, that they don't understand that the biggest deal they've ever done that's closing today has a downstream impact on their financial life, but not a direct in the moment impact. We've all done it. We've all done it. We've all gone from a closing to the nice restaurant in town. We have all gone from a closing to the car lot to test drive a dream car. You know what? Let's do this. In a moment of honesty and transparency with ourselves, select in the chat, say, I did. Have you gone straight from a closing to an amazing dinner where you treated yourself, or a car lot, or a Louis Vuitton store? I have. Sandra with I have not. Look, of course, most of us have done this. And my point, I see some no's. I went to Hawaii. Okay, that's fair. It's okay to say no, but also it's okay to say yes. This is human nature. This is human nature to be given, to have earned a significant amount of resources and then to deploy those resources immediately. It is not that unusual. I don't know. Have you ever run a half marathon or a marathon and then had a big dinner that night? Yeah, it's not that different. You were in a caloric deficit and you filled it up. In the moment of a big closing, you have a surplus of money and you're going to take care of it. But here's the challenge. Here's the challenge. If you're trying to set yourself up on a salary And the good moments cause worse behavior that is problematic. I want you to think about this like a non-commissioned salesperson should think about this, okay? For most people who don't live 100% on commission, the day they make the best decisions is the day before payday. So let's say your neighbor Gary gets paid on Fridays. Gary does not get DoorDash on Thursdays. Gary makes his worst decisions on Fridays. Gary makes his worst decisions on the day he gets paid. So all of us are wired that way. And when it comes to earning a commission, and then we're going to talk about taxes in just a moment, after you set aside money for your tax obligations, then how do you sort through the money from there? Darlene says she's brand new, has not closed her first deal yet, but she plans to. I wonder if that means she plans to go to dinner or if she plans to close the deal. But I think all of us in this call today say, you know what, Darlene, both close the deal and then take yourself to dinner. You absolutely got this, and you absolutely deserve to have a little taste of success with everything that you've learned and applying it to this new industry. High earners are actually more fragile, not more stable. Here's the reality, is the higher the income you have and the higher percentage of that income you need, meaning you're dependent on your income, the more fragile your financial life is. So I've been a columnist for USA Today for a very long time. I have yet to be invited to write for Canada Today. But if I was invited, I would do it. Anyway, back in April of 2020, and I know you and I just met, and me bringing up spring of 2020 is considered rude because it was a horrible, horrible time. But I remember getting an email from a reader of my column saying, hey, I have a $75,000 base income, but I make $200,000 a year. In other words, this person's incentive compensation, bonuses, commission, whatever, was $125,000. She went on to tell me that that was the level of income she had earned consistently for 10 years. So I want you to think about this for a second. For roughly 120 months, she had earned roughly $16,000 per month for 10 years. And when the pandemic came along and she went on to share that she was in the travel industry, that 125,000 American dollars went to nothing, and the base salary was 75. Yet her financial life was wildly fragile. It was wildly comfortable, but it was wildly fragile because she was so dependent on that higher level of income she'd earned. I think the tricky part about being on a commission income, again, as someone who has done this before, when you think back to the best year you ever had, in fact, I don't want anyone to type anything right now. I just want everyone to think about this for a second. I'd tell you to close your eyes, but I don't know if you're driving around in your Cadillac or not, and I don't want that level of liability. But everyone just take a moment and just think about the best year you ever had. The best year in the business you ever had. And if you're just new to the real estate business, I want you to think about the best professional year you've ever had. If you're new to the workforce and you are recently in school, you can sit this part out. It's okay. Okay, everyone think about this. Best year you ever had. What 90% of people on this call just did, including me, is you thought about the highest grossing year you ever had. You thought about the most homes you sold. You thought about the most commission that was earned. And what you didn't necessarily do is you didn't say to yourself, 2014 was the best year because I saved the highest percentage of my gross earnings for the future. And in fact, that is how I want you to measure whether you had a good financial year or not. You shouldn't feel bad about this. Nothing we talk about today should make you feel bad about yourself. In fact, my goal is to make you feel smarter. Think about this. If you were to call in a financial planning shop in town. Like you just like remember when there was a Yellow Pages? Anyway, you just call a financial planning company and you say, I want to talk to your best financial advisor. Okay, you just say this to the receptionist, the person answering the phone. I don't know who I want to talk to, but I want to talk to your best financial planner. Do you know who they're sending you to? They're sending you to the top grossing financial planner, the person that makes the most money, not the actual technical best financial planner. So we are predisposed to make these sorts of judgments. When we say best, we tend to say most money. What I want you to do through the course of our conversation today is I want you to start valuing stability over comfort. Stability over comfort. I can help you understand the difference. Let's talk about comfort. If I were to see you on the street, I noticed you from your yard sign. I was like, it's Carol. Hey, Carol, there you are right there with your necklace and your folder there. Carol, how's your financial life going? And Carol, if you were to say, that's pretty good. It's pretty good. We went on a better vacation this past year than the previous year. I drive a little nicer car, able to go out to eat a little more often, worry a little bit less. All those things are great. And I hope every single one of you enjoys those things. But what Carol just described is comfort, ease, a lack of stress. What Carol did not describe is stability in any way, shape, or concern. And the interesting part about this is most of us confuse stability and comfort. We say, I've got more money in my checking account than I did last year at this time. That clearly is stability. No, it's actually not. If the money isn't bringing you stability, if it is not bringing you functional stability. You don't always have to make more to keep more. I think the biggest, we'll call it a moral victory, but sometimes moral victories are considered to be negative, right? You really lost, and so you had to make up the rules of what makes for a victorious moment. I'll say this. There are some people on this call that this year will gross less than they grossed in 2025. It's just a fact. I'm not cursing you with that, and whatever. It just is what it is. However, the hope is that the person keeps more. They are less dependent on their income than they were in 2025. There's another way to talk about income dependence. All right, so let's talk about retirement for a moment. A very strange concept for real estate professionals. Having dealt with sounds so negative, doesn't it? Having worked with real estate professionals a lot in the last couple of decades, I can tell you this. Retirement is not a common topic. It's just not. And if you get a real estate agent to talk about retirement, what they'll often say is, I'll likely just sell real estate part-time in retirement. I would argue it's even a selling point to join the industry. But here's the challenge. Most Americans, most Canadians, when you think about retirement, you think about this concept of financial independence. What are you independent from? You are independent for the need to have active work income. You are independent for the need of active income. Okay, so let's think about this in current terms. Right now, we're going to do this in the chat. We're going to see how good everyone is at math. Usually I start with this like, hey, there won't be any math. It's going to be okay. And then I say, I lied. There's math. Hey, there's math. Let's say right now you spend, forget taxes, you spend 90% of the money you earn. How much money are you not dependent on? You spend 90% of your income. How much money are you not dependent on? Ashley, firing away quick. Justin, I confused Justin. Sandra, I've confused Sandra. It's all right. Nathan is also slightly confused. There's no shame in this. The answer is 10%. Ashley nailed it. Hugh knows. Heather knows. Cynthia and Carla know. Jean knows. 10%. Okay, so why does this matter? Why does this matter? If you spend 90% of your income And it means you're theoretically are not spending 10% of your income, which means you've broken your dependency on income by 10%. Now, next year, you spend 89% of your income. You spend 89% of your income next year. How much of your income have you broken dependence on? Ashley, you were so good at this. I, I'd give you a prize. I don't have anything. Broke, crack screened iPhone. You want that? 11% total, and you've broken it by an additional 1%. So if you think about your financial life for a second of, was this year better than last year? Most of us are going to go, I sold this many homes last year and I sold this many homes this year. I made this much gross commission last year. I made this much gross commission this year. I don't mind if you keep doing that. But if you actually want to be financially stable, what you need to measure is, have you broken your dependency on your income or not? It is virtually impossible to retire if you are not down to 70% dependence, 30% independence. And you can quote me on that. It is virtually impossible to retire unless you're at 70-30. And you're hearing this and you're going, oh, that's okay. Well, I set 30% aside for taxes. I said this is absent taxes. I'm talking about retirement plan deposits, money into savings, money into college funds for your kids, paying down debt. If that amount works its way to 30%, you're good. If you're nowhere near 30% independence right now, it's totally okay. It's totally okay. However, retirement's not around the corner for you if that's the case. What I would love is you learn this today, you take a look at where you are, and then you just increase it by 1% a year until you're ready to hang it up. Really. I mean, if let's say you're at 15% independence today, right? You're setting aside 15% of your income. You don't need 15% of your income. Over the next 15 years, if you increase it by 1%, you'll be at 30%. All right. Let's talk everyone's least favorite topic, politics. No, taxes. We're going to talk We are not talking politics today. Can't do it. Okay. Here are the biggest four mistakes that agents make, whether you are north of the US-Canadian border or south, whether you're in Ontario or Ohio. These are the things people do. If you treat gross income like spendable money, it's problematic. Again, here's what you and I do. I know it. I've done it. You do it. You come to terms on a deal. Okay. You get an offer. You accept the offer. You do the math. You've calculated your commission. And from the moment you calculate your commission to the moment you receive your check, to the money hits your account, till you start to spend it, if you think about that deal through the lens of the gross amount, you have an opportunity to do that differently. That's me like going through social and emotional learning, not telling people they're wrong. Here's what this means. Let's say you have a commission, it's $15,000 gross, okay? So you calculate, the offer goes through like, I just made 15 grand. Okay, great. Here's what I recommend you do. Call it 10. Just call it 10. If you are just in your own free time, thinking about your deals, calculate the commission, and you're walking around with the gross amount in your head. When you create little spreadsheets or grab the back of the napkin and you start writing down what's going to happen in the first half of 2026, if you're using the gross amounts, you're missing a massive opportunity to just net it down for taxes immediately. Next up, Quebec, it's 50%. I know I mispronounced Quebec. I tried a different way, but I'm just self-aware. I'm not courageous. So I'm sorry for that, Peter, but we share a name, and I feel good about that. All right. So let's not guess on quarterly payments. As we know, in the US, we call them estimated taxes, and in Canada, it's tax installments. In the US, they're due in April, June, September, and January. In Canada, March 15th, June 15th, September 15th, and December 15th. Maureen asks, is this a beginner class or will it get more advanced? That's confidence inducing for me. I like that. All right. Uh, Here's the thing. If you are guessing on quarterly estimates, you will guess wrong. You will. And you'll either hold too much back or you won't hold enough. And that's also going to cause anxiety. I'm going to skip down to the fourth point and then come back to the third because I think it gets to the heart of the tax issue for us. Do not hire a tax preparer. Do not go to the local shop at the end of the corner where the person is simply an enrolled agent and you use software. You need someone who is going to work tax strategy with you. I highly recommend you do not use tax software to calculate your taxes. You need an expert to help you calculate the right strategy. I love do-it-yourselfers, and you don't either. For sale by owners are a lot of good time, aren't they? Do you know how upset you get by FSBOs, yet you have your taxes prepared via software? Do you know how interesting that is? You know, you need an actual tax professional who's going to walk you through this. Another thing that a lot of people do, whether they've been in the business a very long time or a very short time, is they confuse deductions with strategy. Let's write it off. Let's write it off as a deduction. You can write off my car expenses, going to write off half this meal. And inevitably, what you do is you waste a tremendous amount of money. I'll just say this, my business is not what it used to be. And that's usually a negative phrase. My business is a lot larger now. I'm no longer a financial advisor. I'm the CEO of a financial wellness company. We serve about 800,000 people. When I was just a dude by myself without coworkers and employees, what I found is that I would put just about everything I could through my corporation and I would write off everything. Anything that I was like, I probably shouldn't do this, I'd be like, well, it's not that bad if I write it off. Do you know how much I regret that? Do you know how much I regret giving myself a blank check to make dumb decisions under the guise of it's a write-off? I want you to think about the lean times, the times where you were a long time between the last close and the next close. And I want you to think about how stressed you are and how many times you say to yourself, never again will I put myself in this jam. Yet, when abundance strikes again, inevitably, what you do is you start these series of write-offs. I highly recommend that that's one of those mistakes that you try to avoid. All right, let's talk quarterly taxes. I'll say this, it is not unusual if you've just started in the business to get the tax surprise. I think everyone on this call has gotten a tax surprise. You know what? I don't want to say that. There's enough people that have said no to questions I've asked already. I bet 90% of people on here have had a tax surprise and 10% have not. I tend to use 30%. Now, I know taxes are different in Canada specifically. Instead of state tax, you have province tax, and then you have your Canada pension plan requirements as well. Some people have, I'm curious, actually, for Canadian folks only, what is your rule of thumb of what percentage of your gross receipts do you set aside? I'm just curious. All right. Aspen says 30, Chelsea 30. Okay, so I'm seeing 30 to 40. Peter, I know you put 50. I know this about you. You told me earlier. 30 to 40. Okay. Gene, that's aggressive. All right. So can all the Canadians stop typing numbers for a second? All right, Americans, United States folks, what do you do? What are you setting aside? And be honest. Be honest. Some of you can put 95%, Andrew. Wow. And Gene's back with 5% again. Thank you, Paul. Susan, thank you. Daisy, that is also honest. And Robert, you're being honest. I love Mara Lee, if I pronounce your name correctly, all of it. And I pay myself a weekly check. I love that. Okay, here's the point. Have a rule of thumb, meaning you set aside and you truly set aside. You set aside it in a different account. You do not tap that account. It is not your savings account. I think one of the biggest mistakes I see in these situations is that people actually use a checking account to set aside these tax payments. And then when things get lean, they tap into the tax savings. I like to use a completely different financial institution that is a savings account that I do not have ready access to. And then when you least want to deal with it, underpayment penalties start to sneak up. And here's what I mean by that. If you had a year in which you had to tap into your tax savings, that means in that moment, some things were not going right for you. Can we all acknowledge that for a second? And then at the end of that season, when you get the tax bill because of that, things get markedly worse. So you have to do everything you can to keep that money away from you. Here are deductions that matter and ones that don't. As we talked about, there are certain things that are audit bait and you want to stay away from. I will note, at least in the United States, the number of audits that are occurring are declining significantly. There are just simply not the resources. This is not to talk you into taking risks. In fact, I don't think you should do it. Home office deductions are an interesting thing. There are a lot stricter rules in Canada than there are the United States. And then there are different rules in Canada and the US as it relates to vehicles as well. Based on, I don't want to talk about this. 2026 could be interesting from a fuel expense standpoint. You're going to have to do some math. I think oil prices are likely going to stay up for a little while. And so if that's the case, you need to take into consideration whether you use the mileage costs or the actual cost. You need to really think through that. It's going to be a different year than it's been in the past. If your tax strategy is my CPA will fix it, you don't actually have a strategy because hope is actually a terrible financial strategy. Now let's talk about commission life. I don't think your financial challenges have anything to do about income. I think it's about timing. So I used to work with professional athletes quite a bit, obviously not as their personal trainer. And here's what I know specifically about NFL players, so American football players, is that they get paid 17 weeks in a row, and then they get nothing for 35 weeks in a row. And the only people who can properly contextualize that are people like realtors who are like, oh yeah, well, I got paid in January, April, a lot in August, and twice in October, right? So you get how unbelievable these things can be. The feast or famine thinking is one that you can get addicted to, and it can be a real challenge for you. We often talk about paying yourself first and paying yourself like a professional. And inevitably, what we do is that we do not pay ourselves the right way. We tend to try to reward ourselves as opposed to save money for the future. So I'm going to give you some retirement contribution percentages here that should be rules of thumb for you as well. So let's say you're going to take, in this example, 30% off the top. So you took a $15,000 commission, you reduced it down to a $10,000 net. So we are now at $10,000. The $5,000 you've set aside is now an afterthought, it is gone. What percentage of that $10,000 should actually go away for the long term? This is an interesting question. In the chat, what percentage of that $10,000 commission should go away for the long term? I'm seeing some really, really aggressive numbers here, and I love it. The reality is, done this long enough to know I don't often see this from realtors or any other professional. The answer from a retirement standpoint, if you're in your 20s, If you're in your 20s, and clearly I am not, if you're in your 20s, it should be 12 to 14% for retirement. 12 to 14% for retirement. If you're in your 30s and you did not do 12 to 14% in your retirement in your 20s, it's closer to 16%. If you're in your 40s and you previously did not do that, it is actually closer to 22%. That's the tough part about this, is that if you are not measuring your success with the right metrics, you can have a pretty wicked surprise in the end. I'm not trying to alarm you or scare you or make you feel bad. I'll just say in sales, there are so many different ways that you can convince yourself that things are going really well. You're not actually getting more stable. So here's how I like to think about a simple cash bucket system. Number one, a question was asked, what if you were in your 50s, 10 year from retirement? It depends what you have saved. Actually, I'll do this for you, Lori, I think, yes. The question is this, and it's a good question for a financial planner to run through the numbers with you. If you've got 10 years left in retirement, you actually want to have saved about half of the money that you think you need 10 years from now. Okay, so I'm going to give you round numbers that are not realistic, but the halving works, okay? Let's say you've done the math. You need $1 million to retire 10 years from now. Right now, you should have $500,000. You know you're on track if you have half of what you need 10 years from now because of how money compounds. If you're close, then your contributions, the contributions you make over the next 10 years can get you there. If you're like a quarter of the amount saved, then you probably are not going to retire successfully in 10 years. And the fact of the matter is, it's probably not $1 million either, right? It is probably $2 to $3 million. And the way to think about this is how I do it at my house. You're welcome to adopt this or dismiss it, take it or leave it. I like 3% distribution rate, right? So if I had $2 million, then it can consistently create $60,000 a year for me. In order to create $120,000, I would need $4 million. Now, the reality is this. Number one, Social Security or the Canada Pension Plan are going to supplement that income. If you're very young in the United States of America, you have to really think about, will that Social Security system be there for you? If you're a little bit older, it is likely to be there for you. Let's talk about selling investments. Let's talk about the things we do to get out of a bind. There's no doubt that at one point in time, you had an absolutely killer year and you put a lot of money away into long-term investments. Our goal as we plan financially is to have 3 buckets. You have a short-term emergency fund, which for realtors should be bare minimum 6 months. This is all besides your tax account. So your tax account is somewhere else, but there are 3 other buckets. The first is your savings. I love 6 months. If you've been in the business 5 years or more, you can probably work that way up to a year. The third bucket, yes, I'm skipping over the second bucket. The third bucket is a bucket that is for retirement. If you're in your 20s, it's 12 to 14% of your income on a regular basis, and that is important to do. And then the mid bucket is how you get to enjoy the fruits of your labor a little bit. This will allow you to save for college. It will allow you to retire prior to 59 and a half, so you don't have to tap your investments. Those are the things that we really want to look at. That being said, let's look at a few myths here. Question asked, retirement fund goes into a 401k or IRA, you suggest? A 401k is going to, in many instances, allow you to put more money away. There are certain IRAs that allow you to go a little bit higher with that. A SEP account, like Jim said, is what can get you probably the highest level of contribution that you can write off. Talk to a financial advisor in your area about that. All right. Investing can wait until later. The biggest regret I have financially is that when I was killing it when I was 22 through 28 years old, which as you can tell was quite a while ago, I was really enjoying myself to 22 to 28. And I think about as a 40, how old am I now? 48. That's how you know you're old. You don't even remember. I'm like a 47 or 48. I actually don't remember. I'm 48 now. My net worth would be twice what it is now if I did what I was supposed to do when I was 22 through 28. Those 6 years of underfunding made a massive, massive difference. Real estate is an investment plant by itself. Did I say plan? No, I meant plant. There's a lot of ways you can grow your net worth like a plant. Real estate is certainly one of them. There are a ton of realtors that say, look, I know real estate better than I know the stock market or the equity market, so that's what I'm going to do. And for those that have successfully proven as a strategy, then absolutely keep doing it. One of my best friends is a little bit of a small real estate mogul, and he never invests in the market, the stock market, because he knows too much about the real estate market to sort of diversify his interests. What I would say for you is this. If you're not fully established in the real estate business yet, you've not been through the various types of market conditions, putting all your eggs in one basket is a tough way to go in that regard. A myth of being asset rich but being cash poor is fine. You ultimately want flexibility. The whole point of having financial stability is to have flexibility. It is to not be forced into things you do not want to do. I think the tough part about being a successful commission-based earner is that unless you set pillars and standards for yourself, you're going to find that you're going to compromise your values in this way more than you really want to do. Here are some options I recommend, and these are flying in the chat as well. And these are a little different, of course, in Canada. Solo 401k, the SEP IRA is a very popular strategy, which I recommend. And then Roth strategies can be good when income allows as well. Needless to say, these are the 4 quiet killers. And then I'm going to open it up for questions and answers. I'm going to look in the Q&A. So the chat has been great. We've had a good time with it. But what I would love to do is if you have questions now, start filling them in the Q&A and I'll answer them there. Lifestyle creep's a fun little title that means that when your income goes up, so does your lifestyle. For those that have been in the business for 15 to 20 years, think back 5 to 6 years ago in which your income was lower, yet now that it's higher, it can often feel like you don't have more of a cushion. That is called lifestyle creep. And in fact, it's what it really is, and we talked about it earlier, is you're not becoming less dependent on your income, you're becoming more dependent on your income. Instead of having 90% of your income being used, the next year it's 91%, and then 92%. And at that point, at 92%, you're only broken dependency on 8% of your income, and retirement gets very challenging. Look, I'll tell you, when you are to some degree, some people believe this and some people don't. You don't have to. I think there is people in sales can convince themselves very easily that they have an image that they need to uphold. I'm not here to dispute it. I'm not even here to pump it up. I'll just say I've seen way too many people, and you have too, take that too far and actually make things harder on themselves. High income debt is often what you have access to during lean times, and that can be pretty challenging. And then stress as a financial metric is kind of goofy. Like I told you, I want to reduce the amount of financial stress that you have, but I've seen too many commission professionals do this. They'll say, I don't let it stress me out anymore. So what they're practicing is tolerance as opposed to rooting out the root cause for the financial stress. In other words, it's capitulation. They're just sort of giving up and saying, I know it's bad. I just have chosen not to care. That's a tough thing to hear if you're going through it, but it's worth taking a beat and to say, okay, here's how I would do it. What percentage of my income have I broken my dependency on? And let's say you come up with 7%. And then the next question is, does that stress me out? And then you say, no, not really. Okay, 7% is the wrong number. And does it stress you out when it is the wrong number? When you say no, that is the wrong answer as well. I say that with love. I say that you will never get to 8% and 9% and 10% if you are not dismayed by the fact that it is the wrong number. But the fact of the matter is, you have got to find the right mix of stress and not being stressed as it relates to changing that. So let's hit a quick financial checklist for agents, and then we will get to questions and answers. First, separate business and personal money completely. Please do this. Please, 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 please do this. Every horrible tax and real estate financial struggle I've ever gotten to witness involves a person just commingling business and personal money. You must automate your tax savings. There are going to be a lot of reasons you can come up with to not do this, especially if you're in a lean time right now. I recommend paying yourself a consistent salary. And even when you have a killer month, I recommend that consistent salary. After 12 months or so of working that salary, if you want to work out a business program or a bonus program for yourself, feel free to do so. Fund retirement before upgrading your lifestyle. And then finally, review your finances quarterly on purpose, not just because a tax payment is due. So let's do this. I'm going to go to the Q&A. I'm going to pull it up on my screen here and we'll get to it. There it is. All right. We've got a few minutes left, so we'll make sure to get as many as we can. More info on the deductions that matter, the ones that don't. Well, Nicole, thank you for that question. Really depends if you're in the United States or if you are in Canada. I would say this is that the biggest key for me is getting your home office deduction correct, if it in fact applies to you, and then getting your auto deduction correct and not choosing the right methodology. Depends a lot about how much you drive, if you have a car payment and those sorts of things. A lot of specifics around it. A good simple accounting system for real estate agents, how much to set aside for taxes, how much for business, how much to pay myself, and how owner draw or pay scale. Okay, so what's the easy system? People love rules of thumb, okay? I've said it a few times. I'm going to go back to it real quick. 30% is a great starting point for tax withholding. For some of you, it has to be 40 or 50. Some of you can get away with 20, but at least start with somewhere in the 30 range if you don't know. Okay, so then you've netted down a number. At that point, you got to set money aside for retirement. Is the hardest thing to set money aside for because your current life needs the money worse than your retirement does, or at least that's the way it feels. I like at least 15% of money for retirement. So I'm going to go back to that $15,000 deal for a second. $15,000 deal, 30% off for taxes takes us to $10,000. I said 15% towards retirement. That is now netted down to $8,500. And then that is when you can start budgeting off of that. Jim notes, I have a financial planner, a tax planner, and a payroll company, and I give these people full access to talk to everyone via Zoom or some platform where they can record their meetings without me present. This way they can send me the recording. Is this a smart way to keep information flowing with my team of professionals? Let me read this again, Jim. This is intriguing. I'm glad you asked this. Okay. I give these people full access to talk to everyone, so everyone on that team via Zoom or some platform where they can record their meetings without me present. If they're a trusted group, I think that's fine. And as long as you're reviewing that as well. Yeah, I think that's good. I'll say this. Let's go this route. You have 3 professionals, Jim. You have a financial planner. You should have a financial planner. And most of the people on this call who aren't in consumer debt should absolutely have a financial planner. A tax planner, absolutely. Everyone on this call should have a tax planner. A payroll company. Okay, so Jim, this is interesting. I used a payroll company too when I set this system up for myself years and years and years ago. It is an added expense, but boy, am I glad I did it. You'll have a lot of people, Jim, tell you it's unnecessary, it's a waste of money, it's not a good investment, you could just do it yourself. I disagree with everything that I just said about other people saying that. Absolutely use a payroll company. Is it a waste of money? It is a waste of the money of the sense that you could probably figure it out yourself, but it isn't a waste of money in the sense that it is the ultimate accountability and it prevents you from getting in a lot of trouble. So, Jim, great job. Does it make sense to consistently move money from 401k, traditional IRA to Roth if income allows based on AGI? That's a great question. It has to do with converting to a Roth IRA. Great question for a tax professional. I tend to like that strategy. Can't give you specific advice on that, but I tend to like that. You mentioned automate tax savings. Okay, here's how you do it. Um, you are going to get either a paper check or a deposit at closing. In that moment, you go in that day and you move 30% into a savings account that is attached to that receiving account, and then you leave the money there to pay taxes. It doesn't have to be any more complicated than that. Someone asked, what is the name of the book I wrote? The one I wrote, I was looking if there's a copy around here. There is not, because I'm unprofessional. It is the one about commission is called The Commissioner. The Commissioner is what it's called. And then can we send these slides? Yeah, I'll get these slides to the folks at REMAX and we'll go from there. All right. I think we did it. We did it. Let's bring back our hosts to send us the rest of the way.
Thank you, Peter. We really appreciate you being here with us today and sharing your financial knowledge. It's such an important topic. So thanks for being with us today.
My pleasure.
I do want to preview our next session. Our next session is going to be on June 18th. Our speaker will be Travis Robertson, and he will be speaking on how to use pipelines, automation, and AI to close more deals. So thank you, everybody who joined us today, and I hope to see you all again in June.